All right, welcome back to the show, Tucker. How's it going?
Good, Dan. How are you?
Great. Well, I was going to ask you what you did this weekend, but you and I went and checked out a rugby game this weekend. That was pretty fun, right?
Yeah, it was an amazing game.
Not your first game, as I understand it, but they won like by 2 points in literally the last 30 seconds.
Absolutely. Yeah, no, and I appreciate you explaining the game to me and all the rules and all the nuances to strategies. It was a great time.
All right, so today we're talking about common purchase offer contingencies. I thought it would be a good idea to have you on in this conversation because specifically having a lender and a real estate agent that are on the same page really makes a difference for a buyer in this market.
Exactly. And that's the key component is having these conversations up front. So it's not, 9 p.m. and they're thinking about should we make an offer and then, what do we do with the contingencies? And then they're calling me or they're calling you and they're trying to figure it out. It really needs to happen before the home hits the market and before they're even considering making an offer.
Yeah, no doubt. All right, so what are the common contingencies included with purchase and sale?
Yeah, so there's really a big five. First being a home sale contingency, so the necessity to sell a home before you can qualify to buy a new home. That's the first one. That's probably the biggest one. Then you have finance and appraisal contingency, which is really two and three. So there's two more there, and then inspection contingency, which going to leave that in your court. I'm not going to touch that one. And then we also have a wide variety of some other contingencies that involve neighborhood review, HOA review, condo association review, or really I can't say the word, a number of other miscellaneous contingencies that you could potentially write into a contract.
Yeah, for sure. And obviously, the most common one is that inspection contingency. A lot of buyers are thinking that they get a peek at the home. They want to, if you're buying a car, you can take it down and have a mechanic inspect it. So there's a couple of there's a number of things that go into the inspection contingency. But from your standpoint, which one of these are you most affected by?
Yeah, really, it's the first three. So first, a home sale contingency, that need for somebody to transfer equity from their current home to buy the next home, and there's a number of ways that we can either get around it, or in some instances we have to include it. So first, the key component is having that person get pre-approved to determine is it absolutely necessary to sell first, and there are ways to potentially get around that, a bridge loan solution where we could potentially put a loan on that departing residence to capture some of the equity to put down on the new home to allow them to buy first, then sell and pay off that bridge loan down the road. Or if they have some money saved up that they could do a minimum down payment and buy today, they could potentially buy first, move in, and then ready their home for top dollar, sell it, and then use the proceeds to do a process we call recasting, where they do a large principal reduction down the road after they've already closed on their home to reduce their payment. I think ultimately they want to get to that lower payment with those proceeds so they have a much lower loan amount. And we can do that through recasting, which is just a process of us re-amortizing their loan based on them paying ahead of schedule.
Yeah, I think there's another thing to consider too here from a standpoint of if somebody can qualify with a HELOC, maybe they have enough equity to pull
Yep.
out some of it, the bridge loan, also renting that property. So if somebody lives in a home and they actually already have a renter lined up, can they qualify with that rental income?
Yeah, they can. I'm careful with the word income, but we can use it to offset their debts. So if
Okay.
there's no history of renting out that property, we can use a 12-month lease. They have to collect, have a bona fide lease for 12 months and have collected a security deposit. We can then use that lease amount minus a 25% vacancy to offset the debts of that property. So any mortgage, taxes, insurance on that property up to a full wash of that payment. We can't give them more income, but we can omit the debt.
Gotcha. So that's just another way to avoid having to use a home sale contingency. So out of respect for time, let's move on to the next one. But
Yeah.
because there's a lot of different moving parts, I will want to mention a little bit about the appraisal contingency.
Yeah.
That one in there is it's actually a part of the financing contingency. How does that come to play from a lender standpoint?
Yeah, so the appraisal is a big one in our market, especially in multiple offer situations where you have escalations. Really, we never know exactly what the outcome of the appraisal is going to be and where that value comes in at. But as a lender, we can only lend up to the appraised value. And in some situations, you have a buyer that's willing to pay above that appraised value. And we have a situation where there's a gap between where they're at under contract with the seller and what the appraisal tells us the true value is today. And we have to handle that. And there's a variety of ways that we can do that. One is the buyer can just make up the difference and bring in that cash and say, we're good with it. We'll own the home long enough for the value to appreciate and get there. But that's, to your point, we have to determine, do they have enough funds to handle that gap, and how do they want to handle it? They can, and I don't want to step in your lane, but there are ways to write into the contract that they're willing to cover a certain portion of that gap, without just opening them up to liability for the entire gap. So do you want to touch on that, the 2280?
Yeah, so that is a situation. If you have a client that is pre-approved and they're cash strong, meaning that they've got, because right, the most favorable terms you're usually getting with 20% down, right?
Yeah, exactly.
Yeah.
Yep.
So essentially, if you have more than 20% down and you're in a competitive situation, we had a client that had to bid quite a bit above asking price. And you start to get into the realm, well, have homes in this neighborhood sold for that amount, and they're moving into a home that they're going to be in for the next 10 years. So the liability of quote unquote overpaying is not really something that's a concern for them, because they're planning on moving there and being there for quite some time. So therefore, they utilize what's called a 22AD, which is an additional down payment in the event that the home appraises for less. So just a simple situation would be you as a lender is going to lend somebody 80% of 500,000 if that's the purchase price, right? If the property doesn't appraise for 500,000, say 490, they're still only going to provide 80% of that. So the buyer is going to use this 22AD additional down, saying we already got it. So if it doesn't appraise, we're going to cover that shortfall. So that's one of the tactics. The last one is that neighborhood HOA review. Do you got anything to add there on that one?
No, the one thing I would just caution on, and you mentioned this, is the condoizing of lots, where you have a single family home that's existing and you have these developers and investors that are adding DADUs, ADUs, and they're converting it to a little mini condo association. We just need to make sure that those HOAs are done correctly. And so I would just say, before waiving financing on that type of property, we need to talk about the association and make sure that they've done things correctly to be able to allow for lenders to come in and do a financed loan on those properties.
Yeah, two things. Yeah, that is an interesting thing, because that will be a lot. The condoizing and the maintenance of common grounds and all that stuff, especially
Exactly.
with the DADU and ADU kind of product coming along. Okay.
Yep.
Well, that's a lot of stuff, and we've got a lot of guests. I appreciate your time today, Tucker. So thank you for coming on.
You bet,
Appreciate
Jeff.
it. Everybody knows there's Tucker's phone number going across the bottom, 425-757-9202. Give him a call. Stay with us after this short break. We're going to bring in Lisa Schultz. Spring cleaning time. Come on back after this short break.